It's Thursday, July 11th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio, the one and only Bill Mann. Thanks for being here.
How are you, Chris?
I'm doing well. We've got some earnings.
We do, sort of.
Well, we have actual earnings.
We have results.
And we have earnings in air quotes. We have a pretty interesting story from Amazon, and we'll get to that. Let's start with Delta Airlines. Record revenue in the second quarter for Delta. The stock is not up big today, although year to date it's up about 20%, and it's close to an all-time high. This really does seem like what we have seen over the last couple of years from Delta Airlines.
Yeah, Tim Byers from the Discovery Services, who works with me, has been a tremendous bull on Delta Airlines, and I have to say, he's been exactly right about this for some time. These are great results. They're profits are up about 30% over last year. Record revenues of $12.5 billion. Per share profits of $2.35 for the quarter. They raised their estimates for the year. But the interesting thing to me about Delta and these results is that they come at a time of some real upheaval and some real problems for their competitor airlines.
We'll get to the stock in a second, but it does seem like, if you just back out from any individual airline, the number one story in this industry is the Boeing 737 MAX.
Yeah.
For now, at least, it doesn't appear to be harming Delta's results.
No, because they don't have it in their fleet. So the Delta CEO came out and said, well, it's kind of a marginal benefit to us. Wait a minute. Because American Airlines just came out, which has a tremendous, fleet of 737s that are parked on a tarmac somewhere, said that it's going to cost them $185 million in gross profits, in pre-tax income, I should say, for the quarter. So Southwest has got them. United to some extent was ramping up the 737 MAX. Delta wasn't. So that pressure has to end up someplace else. This is thousands of flights that are being canceled. So yeah, marginal to me seems to be a little bit of, hey, we're trying to take credit for stuff that's a little bit lucky.
I was just going to say, let's, Ed Bastian, the CEO at Delta Airlines,
who's done a tremendous job. I've got no beef with the job that he's done.
Yeah. It is one of those things where they got to say something about it. So yeah, look, we've seen plenty of CEOs in plenty of other industries do far more self-inflicted damage, answering questions or weighing in on a given topic. So we'll give Ed a pass.
I would love a little tongue in cheek, like scoreboard, or yes, we were very smart. We knew.
Yeah.
Yeah. Of course we knew.
Like, really? You knew the whole time? In terms of Delta, the stock, it's within $1 of an all-time high. Do you look at this stock, put aside how well the company's been performing, just on the merits of the stock, on the valuation, is it expensive to you?
No, but the big caveat is you got to tell me what jet fuel prices are going to do, because fuel prices have come up a little bit, but Delta has tremendous hedges in place. So they've got, for years now, they're going to have forward rates that are going to be pretty good for them. So I really don't think it's expensive here. The airline, Delta itself, has done a tremendous job of training up its employees. Delta seems to be in a different place reputation wise than than many of its competitors at this point. It is a preferred airline for a lot of people. And I never thought that I'd actually even say that about most U.S. airlines, but Delta has really done a great job. And so, no, I don't think that it's expensive.
Here's something that's definitely not expensive. Bed Bath & Beyond shares are down today and hitting a new 52-week low. First quarter revenue for Bed Bath & Beyond was weak. They lowered guidance. Here's the thing.
You don't want to be mean.
I don't want to be mean. But in thinking about when we've talked about this company, it's probably a slight overstatement to say that I have defended this company, but what I have done in the past is said,
no, you're in the tank. Come on.
There's an opportunity there. They have there is some level of brand equity. There is an opportunity, with the right management, there's a way to execute this business because they sell things that people need for their homes. And if you're looking to invest in housing writ large and you don't want to buy Toll Brothers or, D.R. Horton, this is one way to play that, the stuff that goes in the house. I look at this latest quarter and the stock, which just less than 5 years ago was at $80 a share, and today it's at 10. And
spot, yeah.
I really think they are so much closer to the end.
Yeah, yeah. The question is whether it's Bed Bath and Beyond repair. Right, like that's really what it comes down to. Now, you and I both have college-age children, so we have both seen certainly where you go when you want to outfit someone's new house. You're getting your waffle iron, you're getting your towels, you're getting them from Bed Bath & Beyond. So yes, there is absolutely an opportunity there. I don't know what to extrapolate from what's happened with their most recent earnings. And by the way, the comparable sales were down 6.6%. So on a same store basis, it's a disaster. But activist investors have been in there. The old CEO left in May. They've come in. They've got a turnaround plan. I think it's a little early to say the turnaround's not working. They haven't had time to put things into place. But it just, it feels to me like we're talking about our grandfather's retail establishment at this point.
And it does seem, and it's a good reminder about the activists and giving them some time. I do think, though, that 3 months from now, if we see another quarter like this, it better be accompanied by something to give investors some modicum of hope.
Yeah.
Something that says, here's our plan, here's where we're cutting, here's where we're going to invest, because right now I'm not seeing any of that.
Right. They're maintaining their store count. They're holding on to Cost Plus, which is another brand that they own. They bought a couple years ago, which they bought as an incredibly impaired brand. So they do have options. They could strip down their store count. There are certainly inventory changes that they can make, but they really, really, really have to do something. And I think you're right. 3 months from now, the plan. I don't know that they need to show better earnings 3 months from now, but the plan better be defined.
This morning, Amazon announced plans to spend $700 million to retrain a third of its workforce in the United States, somewhere in the neighborhood of 100,000 employees.
Yeah.
One of the examples that they used was hourly workers in fulfillment centers, offering retraining to move into IT support roles, that sort of thing. This is a big plan, but I think it speaks to a number of things, including just how tight the labor market is right now.
Yeah, this was, for me, I don't know how you reacted to it, but when I saw this was a wait, what story? Because the thing that we believe to be true about Amazon, I think the thing that is almost legend about Amazon is that it is a fully efficient fulfillment center now, that they are really, really good at going down to the penny in terms of cost of getting things out the door. So for them to come out and say, we're going to spend $700 million because we have 100,000 employees who may be rendered irrelevant or rendered obsolete in the next 5 years, that's an amazing story to me. And I'm not sure. I think it's probably good for Amazon. You're right. It's a sign of how tight the labor market is and how scary it is bound to be for the lesser skilled segment of the American workforce. It's got to be terrifying to Amazon's competitors, though. Oh wait, they're gonna be even more efficient.
Right.
Like we already can't compete with them because 100% of their revenues go reinvested back into the business at a zero cost. But now they're going to be more efficient. That's great.
Well, and the mentality reminded me a little bit of something you and I have talked about for years in relation to Costco and longtime CEO Jim Sinegal's approach to pay his employees significantly more on an hourly basis, in part because he looked at it not just through the lens of, no, I think this is the right thing to do, but also from an efficiency standpoint. It's going to be better for our business if we can significantly reduce the turnover. And Sinegal was always very proud of the fact that Costco, relative to other major retailers, had much lower turnover in the employees. And that's a little bit of what I took from this story today couple that with the tight labor market. And it's like, you know what? It's going to be money better spent and more goodwill generated if we offer this to existing employees and we keep them in-house rather than go out and spend even more money to try and hire a whole new workforce.
I think that's totally right because there are plenty of IT workers out there. I mean, not that 100,000 people at Amazon are going into IT, but they are most certainly. The reason that this is happening is that Amazon is recognizing just how quickly that technology is changing jobs. It is probably certainly cheaper for Amazon just to say, hey, we're going to hire people just out of school, just out of high school, just out of college who we can just train up, as opposed to taking their existing workforce and saying, we are going to teach you how to respond to a new technological reality. So put that way, I think this is really this is great. But I was just surprised to see it from Amazon because, it's like the old Chili Palmer line, does the pressure get to you? He goes, no, I'm the one applying the pressure, right? Amazon's the one applying the technology. So for them to come back and say, this is actually impacting our workforce as well, to me was pretty remarkable. Anyway, Wall Street Journal has a story on it, and I highly recommend it.
That's a nice pull with Chili Palmer.
Thank you.
Get Shorty. Good movie. One programming note, Motley Fool Money this weekend. Our guest is Carl Quintanilla from CNBC. CNBC has a new documentary coming Monday night on the e-cigarette industry. I watched a screener of it, and it's
the surprisingly tall Carl Quintanilla.
Sneaky tall.
Sneaky tall, yeah.
E-cigarette industry. Eye-opening. It is among other things, it is an eye-opening documentary. Want to give a quick shout out to longtime listener Justin Russell. You can always email us, marketfoolery@fool.com. Justin Russell went old school with the mail, sent a package and a note that said, my wife and I went to Spain for a wedding, and I figured I'd do some boots on the ground research along the way.
I love it.
When I saw Hamon-flavored Pringles, it seemed I would be remiss if I didn't get some for you. Keep up the good work. And so this, the Spanish word for ham, we have not opened these. We'll crack them open once we're done tasting.
I am pro Pringles and pro ham.
Yes.
But wait, there's more.
There's more because he sent on a comparison basis a small vacuum sealed package of ham from Spain. So
Spain. Good at ham.
Yes. Yeah. See, I've not been to Spain, but I hear that about Spain. It's
there's a museum of ham.
Is there? No, there's not.
There is in Madrid.
Really?
Yeah, Museo del Jamón. And all the Spanish-speaking people right now just went, oh, my God, your accent is terrible. I know. But
the museum makes up for it.
The museum makes up for it. Still good information.
Bill Mann, thanks for being here. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Austin Morgan. I'm Chris Hill. Thanks for listening. We'll see you next week.